markets. Andy Brenner is head of international fixed income at National Alliance, joining us now as part of our bond report. Andy, great to have you back on. Is Japan just like a political fight about the next prime minister, or is Japan and maybe others telling us a larger story about global markets?
Brian, thanks for having me on, as always. I think it's telling us a larger story. This new prime minister is someone that really wants to use fiscal stimulus. And the bond market, the Japanese bond market, really didn't like that overnight. The Japanese 30-year back up 14 basis points. That's one of the biggest moves we've seen, and it's now back, as you just said, to a yield that we haven't seen since 1999. So I don't think it's going to be good for the long end of the bond market globally. We saw that a little bit in Europe. We're seeing it a little bit here in the U.S. So, I mean, Bloomberg had put out a story over the weekend saying this is the time to buy duration. I don't think that's the case, and they've already been proven wrong for the first day, and I think it's going to be proven wrong again. You know, the U.S. economy, it might be a jobless economy, but but it's still booming, and I just don't see any reason to want to buy duration here. So we're looking for, you know, maybe another 25 basis points higher in yield and longer rates. That's both across 10s and 30s in the U.S.
So how long on the bond spectrum, the duration, as you call it, would you be looking to buy, Andy?
Well, Brian, there's no question in my mind that the next two Fed meetings are going to be cuts of 25 basis points, whether we get an opening of the government or not. I think the government numbers, even when they do come out, really aren't particularly very good as far as their track records over the last few years. And I think we have a pretty good idea that, again, a slowing job market for sure, and we tend to think that that you should be more in the shorter end. And, you know, take advantage of that. We think 2s, 10s should probably get out to 71. We think 5s, 30s, they were out to 126. They're now down to about 103. We think that will get back out there. We think it's going to be more of a standard yield curve, much wider from top to bottom.
If the government shutdown rolls on for weeks or longer, let's hope it doesn't, but if it does, Andy, does it start to crack the bond market?
I don't think so, Brian. I mean, there's all kinds of theories on this, but, you know, I think we're getting decent ideas of how the economy's going by the numbers that have come out. If you look at tried to look at the unemployment number, which didn't come out on Friday, you have that Ravello survey that looked pretty much in line, a little bit higher than expected. You had the ADP number a lot worse than expected, but then there was a comment in Barron's over the weekend that the ADP was doing some annual adjustments, and maybe that number can't be taken as a grain of salt. And then if you continue to watch and listen, you can see that companies are just not hiring, not necessarily firing, but they're just not hiring. They're worried about AI and what AI is going to do to their employment and the number of people that they need, so on and so forth. So I think you keep it in the short end. I think you stay steady in the bond market. You might want to buy some corporates. You know, investment-grade corporates look like a good yield to me. They're up about 7.25%, 7.5% so far year to date. That's not a bad place to be.
No, not at all. Andy Brenner, we're glad you're here in our place. Thanks for joining us. Have a great day.
Thanks, Brian.
Take care.